Hey y'all, thanks so much for tuning in. You are listening to the Crude Audacity podcast, the podcast that talks shop shit and of course all things strategy with oil patch influencers. I'm Catherine Mills and today is our 710 Oilfield news segment. Now this is the segment of the Crude Audacity that addresses all current events directly impacting the patch. Today our topic is risk management, aka hedging. And with the rise of social media within our industry, everyone is out there declaring themselves an oilfield analyst. So to skip the nonsense and get straight down to brass tacks, I connected with the team over at AEGIS. That would be Matt Marshall and Rob Via, and we address price risk management throughout the operators, the service side, gas assets, oil assets, tech, and even private equity. It's a new world out there and you need to know how to protect yourselves. So enjoy this listen. Thank you so much for taking the time. Before you go ahead and hit that little subscribe button for me down in the corner there. That way you can stay up to date on all things Oilfield and of course all things the Crude Audacity. And then leave us some thoughts in the comments. Let us know what you liked, what you didn't like, any other questions you have for Matt or Rob. And on Apple Podcast, if you could rate, review, and subscribe, we would greatly appreciate it. Otherwise, sit back, enjoy, and remember, give them hell. Hey everyone, thanks so much for joining in today. You are tuned into the 710 Oilfield segment. Now, this is the segment of the Crude Audacity podcast where we talk about current events directly impacting the oil patch. Today, I am joined by the team at AEGIS Energy Risk. That would be Rob Via, who is VP of the Rockies, and Matt Marshall, who is the Director of Market Analytics. Now, today, guys, everyone is interested in what's happening across the patch. Every day is a new day in 2020, and it's been quite a roller coaster. So we will be addressing the new price risk regime and how companies across the patch can navigate this new form of volatility. So to kick us off, Rob and Matt, thank you so much for joining today.
Thanks for having us.
Our pleasure.
Are y'all ready for this?
After the last couple of months, I think we're ready for anything.
Yeah, right.
Well, can y'all kick us off by sort of explaining who you are, who is AEGIS, and really where you fall in the spectrum that is the oil field?
Yeah, I'll take that one, Matt. So we are a full-service financial hedge advisor, and we work with upstream E&P companies, helping them around market fundamentals, hedge strategy, trade execution, all the back office work around the hedge portfolio as well. Just kind of a quick snippet here on our scale. We work with just under 200 E&P entities. We manage about, I guess it's a little over 3 million BOE a day of hedgeable volumes across the client base. And so one of the things that I think is important to note with that is it just gives us kind of some unique insight into the market, arms Matt and his team with some unique insights that help build our view. And Matt, feel free to jump in on that as well.
Yeah, and it's a broad type, but we work with the producers of every size, public, private equity backed.
Some PE sponsors as well that we work directly with as well.
Yep.
So.
Yeah, everywhere from 200 barrels a day up to 200,000 barrels.
I think 350,000 BOE a day is our largest client. So
really
runs the gamut. I mean, it's pretty much everybody other than kind of the super majors. It really falls within our range.
Yeah,
so
and today we are
really seeing sort of the I hate to use the word triage, but we are seeing adjustments and pivots and just like where does our company go from here type renegotiation strategies. So you're seeing that from the mom and pop up to the larger midstreams, and I'm sure y'all are following some of our super majors.
Yeah, you're exactly right. I mean, there has been, it was such a change in these companies' position going back to like this winter when prices were, over $60 down to just in the course of just days being in the 30s and then dipping down into record-setting negative prices. Like that completely changes the way you have to look at the risk of your firm. And it's changed the way people trade, the way they put on hedges, the way they change their portfolio with respect to what they plan to produce in the next year. Just it changes all over the place. And yeah, the little guys, the bigger guys, they all have unique needs. But it's it's definitely been a lot of jostling and taking a new look at your hedging portfolio to make sure you're prepared.
You said that so much better than I did.
We've said it a few times.
Yeah, it's been mentioned just a time or two, but and luckily across our client base, we've done our job and helped kind of mitigate the risk with a black swan event like what we've seen here and kind of coming in, and so luckily our clients were in more of a unique position to take advantage of that. If you I don't know if that's the right word to really say, but with adjustments on positions, crystallizing gains, there were some unique opportunities. But our clients were, I think, Matt, it was about 78% hedged for this year when things really went sideways, and so a lot of protection there.
Good planning, Catherine, on your part.
Well, yeah, that's the thing. As a hedge advisor, if you do your job well, maybe you do your clients do better, and you yourself don't have as many financial problems. But what was interesting is that our clients were hedged quite a bit, and they were hedged at a fairly high price. And I think that's something that's missed in the industry, where there was a lot of doomsday talk about what the the upstream industry was going to look like later this year after the big price drops. And what a lot of people don't realize is that there was quite a bit of hedging by private companies who were not reporting. They don't have 10Ks and 10Qs to tell you exactly what their hedge positions were, and they were doing very well. And I think there's emerging like the haves and the have-nots. The haves who had a diligent, aggressive, systematic hedge plan, and they took advantage of $60 prices when they could get it. And then you have some who did not have their plan together, and they're a little different situation right now.
So, Rob, you're up here in Denver with me. Matt, I know you're down in Texas. Oil here is not oil there. The environment, just everything from East Coast to West Coast. So can y'all kind of shed some light on what you're noticing? What's happening out in the Marcellus? How does the Bakken feel? I mean, I know how Denver feels, so Rob, I'm going to let you take that because, again, you're much more eloquent than I am. And then how is Texas, how's Houston compared to West Texas? What are y'all noticing? What's the feel?
Well, yeah, I mean, I certainly would agree that it's been an interesting time here in Denver, and there's still some companies out there doing good things, and that we're well positioned and or are in a position to kind of take advantage of some of the things that are going to be the windfalls of this, on the A&D front, things of that nature. But some of it is also just really on the focus is regionally for some of these players, and where there's opportunities. I mean, you mentioned like the Marcellus. It's a little bit of a different landscape on the gas side than it is for some of the crude players. But also what that means, and taking advantage of some things on basis hedging, and I'll let Matt take that piece of it because he's the technical guy on some of those opportunities. But it does feel a little bit different regionally with some of the clients that we're dealing with. Matt, I mean, what do you have to add to that?
Yeah, that's the way I would frame it too, is that, Houston, Aegis has such a geographical footprint that, it's really about where, not necessarily where your corporate offices are, but where your acreage is. And we see, a lot of concern among the oil or the rich gas producers, and then the drier gas producers are out there going, okay, well, what's going to happen here?
Exactly.
I mean, is 2021 going to be the year? Yeah, and I mean, we can go into it a little bit later, but there's some really good reasons to be optimistic about natural gas prices next year and maybe into 2022. And even if oil is capped by, has a price cap on top of it, depending on what OPEC does and how fast demand returns, natural gas has got a really good chance. And I think our gas clients are really paying close attention, trying to figure out, hey, if we get up to $2.75, $3, at what point do I pull the trigger and add a lot of hedges and say, hey, this is I can make some good money here.
It's also been interesting. It's been interesting too that I will say I've heard from a lot of our gas-weighted clients, specifically those that are up in Appalachia and up in the Northeast, that they're wanting to know what's going on with crude. You've seen that tie-in together now, and there's been, with shut-ins and associated gas and everything, that's the first time that I've kind of seen that out of the gas heavy clients. And like I say, specifically some of the Marcellus Utica players that have been saying, okay, well, we're trying to figure out the supply side with crude and what's going on there, and a lot more interest than I had ever heard out of them.
Yeah, and it's not just a passing interest either. Like you can chart like calendar 2021 natural gas prices against the front month crude oil, and what you saw over the last 2 or 3 months, whenever oil prices started going down, is a very strong negative relationship, negative correlation between gas and crude. And so as crude goes down, gas goes up. Yeah. Because the farther that the oil falls, that means you get less development in associated gas. It means you get NGL prices usually come with crude a little bit, so you get less investment in rich gas, and that means there's just going to be less gas supply available. And when oil prices went back up, what had happened to natural gas? Come back down. And so they're watching it for not just for interest, but like for opportunity. Because if you see oil prices dip again, I guarantee you, at least the AEGIS clients, is you'll have gas producers out there looking for opportunity, looking to take some risk off.
Well, 100%. Heck yeah, I love hearing that. So, we have seen the social media movement hit our industry and no one quite knows what to do about it. But ever since prices went negative, we have also seen the rise in self-proclaimed oilfield analysts. And I appreciate a good conspiracy theory as much as the next person. So let's just jump into it. What was the feeling around y'all's office the day we just kept getting more and more negative? Because I happened to be downtown and I saw absolute panic. Nobody knew how to interpret it. And people expected like below $10. They expected, there were some calls for zero, but negative?
Yeah.
Yeah,
there's a lot going on our internal Teams chat. I know it was like I think that morning I was on an intro pitch or something, and I kept seeing the little thing pop up in the bottom corner, and our COO Justin was like just ticking off the numbers, and he's like, oh my gosh, and so it's certainly a surprise, but and I'll let Matt speak to this a little bit more because he really was front facing with the client base. But as you can imagine, I mean, a lot of inbound stuff coming from the clients, and a lot of kind of having to talk off the ledge a little bit. But
a happy face up front, and then a text to your boss going, "What the heck?"
Yeah, I mean, it was there were some nuances to all of that though too. That and that's our job. Our job is to understand the process with it, but also hey, we're ready for ebbs and flows in this market and in this space, and so there was a lot of inbound things coming in with the clients. Like I say, I'll let Matt talk a little bit more on that.
It was concern. The first question was interesting is that you see futures do what it did. So that was on April 20th, I believe, and that was the May contract going to minus 37 or whatever the number was. The exact number doesn't even matter anymore. But I think there was a lot of education that we were having to do to talk about what our client's exposure actually was, because most producers don't get the futures price. That's not the price they get. And so even if it had settled, that May contract had settled negative, that doesn't mean that a producer would have gotten that price. What they usually get is a calendar month average. So it's the average of whatever that prompt month oil futures price was for that calendar month. And so that was just there was I think 21 or 22 business days during that month. So that was just like 1/22 of their price. So that was part of it, was making sure that, hey, I know you're worried about this, and you should be, because this is probably going to be ongoing weakness in crude oil prices, but also realize that first of all, you're well hedged. And second, that is just one day of the calculation.
Yeah, well, that's something I kind of noticed. As you know, my questions for you guys today are not mine originally. I asked operators across the United States kind of what they wanted to know. And what I was noticing is there is a different interpretation of what it means to be hedged or well hedged from every different shop. So when y'all go in and you're kind of talking to the new guys and getting them up to speed, can you give us a little bit of your spiel and helping people to understand?
Yeah, I'd love to do that. Rob, you want me to run with that just a little bit?
Yeah, sure.
It's basic. I mean, when we say hedging, just to make sure that we understand what we're saying, what you're using is you're using prices that are in the future. They're on the forward curve. They're not the day-to-day prices, spot prices. They're in the future. They're financially settled, which means they're settled by cash changing hands. And what you're doing is you're making a choice of like, do I want to take the price for, say, 2021, how it's being traded right now? Would I prefer to take that price right now and lock it in? That's what it is. There are that's the basics of it. That's how you put on swaps. It's the basic type of hedge. And the way the math works out is that if I look out into the future and I see that next year is trading at, like, say, $41 today, I can make the choice, do I want to take $41 for next year, or would I prefer to, in my mind, speculate and to wait for a higher price?
Yeah.
That's what hedging is. Now, you can get into more complicated things where I can say I would like to use options. And the way you use options, you say, I am willing to trade the opportunity to participate in prices if they go higher, if I'm able to get an insurance contract to make sure that I'm protected if prices go lower. And it's called a costless collar. There's other things you can do. You can just go out outright and buy the insurance if prices go lower. But that's what you're doing, is you're looking out to forward prices. You can talk to AEGIS and find out what they are at any given time, and you can make the choice, do I want that price or do I want to wait? That's what hedging is.
And I think that one of the things, and Matt, you may want to pull up the pyramid, because I think this kind of ties in, but it's also different for each scenario is going to be different, right? And again, kind of getting back to like our scale, working with almost 200 E&P entities that run the gamut of small family office up to large publics. Their goals, objectives, risk tolerances, all of those nuances are going to be different in each case. But and so we kind of look at it in this pyramid of what do you want to achieve out of the strategy here, and you kind of have to go with each base before you move up to the next level. But
right.
For some clients, there's family offices that interest payments may not be there for them because they may not have ever carried debt, right? And that's one of debt is one of the things that really there can be hedge requirements that come along with that, and that's going to be one of the big factors on where we start with looking at how do we build the hedge strategy here. But yeah, I mean, if it's a debt-free company, you're moving up, and maybe that's going to change the strategy on, okay, how much do we hedge in terms of percentages of PDP? How long out and how far out do we hedge, so the tenors on the trades, as well as what structures do we use? Swaps? Do we use collars? Do we do just some single option structures? And so there's a wide variety of factors that can kind of go into that, and that's one of the big things on the front end when we're working with the new clients, and especially those that may not be as well versed in the world of hedging. How do we get down to kind of get to the basics on what do we need to achieve from the hedge strategy? And Matt, I mean, if you want to talk a little bit about the structure fundamentals here, feel free to add on.
And something Catherine said I thought was really insightful, because whoever you're talking to on the operator side, I think they're thinking about it right. Is how do you define hedging? How do you know if you're doing enough? How do you know if you're doing too much? And those are really tough questions that you have, because sometimes the bank makes it simple for you. Sometimes you have debt, and the bank says you must hedge at least, say, 50% of your expected production, or maybe it's 75% of what your PDP, so the amount of production that you would have if you didn't drill another well. But sometimes you have that. Sometimes you have internal restrictions. There are times when it's just purely discretionary, and then it becomes I really think it's a financial statement analysis thing. It's saying that, hey, what type of price do I really need if I need to make sure that I'm solvent, that I can make those interest payments? Or maybe you're in a much better situation, and it's, hey, what price do I need if I want to be able to grow by 5% this year? And that's why it varies for each company. I had a really eye-opening conversation with a CEO. It produced about 100,000 barrels a day, and it was back this winter. I think it was actually November last year. And he's like, if prices go to 60, he's like, I can accomplish all my goals next year. I can do that. The few acquisitions I have in mind. I can, pay all my bills. I can give it we can do stock buyback. And it was like, he asked me, why should I not hedge at $60? Like, man, I have no idea. Like that's exactly the situation you hope to be in, is like you've identified the triggers, the thresholds of prices that you need to meet your goal. You've identified the goal, and now all you got to do is put together a plan.
Mm-hmm. Do y'all find it interesting that this conversation is becoming more and more common now and wasn't in better times, that being 50 and above? I mean, I just find it so, why didn't we think of it then? Why are younger engineers not being taught this? Why is there such a disconnect between the market we play in and the operators within it, and even the service side of our sector?
Yeah, some of these things, it's not. Whenever you have a big price movement down, like you think about like in 2019, where prices for WTI were hovering around $52 to $58, mm-hmm. and I'll stop sharing this for a second so you don't have to stare at my PowerPoint. But the prices were hanging around like $52 to $58, and I think you saw that the prices would go up and bounce off of 52, and they would kind of trickle down and get to 52, and then it's 58, 52, and I think it was hard to imagine what might be a catalyst that would knock us out of that range, like what type of bullish or bearish thing could come along, and I think there was a lot of thoughts that, hey, over the last couple of years, the amount of oil in storage throughout the world, OPEC has been falling. The amount of supply has been falling that's being in inventories. OPEC is systematically reducing its production and propping this market up. And if we get any sort of like supply disruption, you can see prices go super high. Yeah. But I think what people don't realize is that in this industry, I think we tend to be very optimistic, and we hope for that prices would stay elevated, but sometimes we miss some of the big warning signs. And here's what I'd say. The big thing that happened was, at first, this year, was not COVID-19. No. The big thing that happened was the OPEC meeting in the first week of March, where the deal finally fell apart. They couldn't get on the same page, and they said, we're gonna produce at maximum rates for April and May. That's what started this. People forget that. And I got so this is the good news, bad news portion. The good news is that OPEC is back on track with a new policy, and they've been reducing production. The good news is that the market has responded to price, and the production this year is likely to decline. The bad news is we're kind of right back in the same situation we were, where OPEC is holding back about 10 million barrels a day. Maybe it's 7, but it's enough to where if the deal were to break apart again, that's a lot of supply coming into this market all at once.
Well, Matt, you say that, but there are some that argue that the black swan events was just the icing on the cake. We have been in this problem since, the midway boom of the shale market, and that's who's hurting the most. And everyone who has built their exit strategy and their company and their forecast around fracking and anything that you can truly frack, those are the guys that are suffering. So was it really the two black swan events being COVID and the Russia-Saudi feud, or did we sort of start shooting ourselves in the foot a little while ago?
I'd say even before these things happened. So you had U.S. Saudi, then you had early emergence of COVID-19 with China, and then you had widespread COVID-19, and those three things were the big shocks that we got. But yes, we had the market. What in my opinion, what happened was we had a price that had been artificially built up by OPEC action. And it's hard to blame the industry for overreaching whenever you had 2 years of a what I thought was a somewhat coherent, reliable policy from OPEC that kept production offline. If OPEC had not been so disciplined with that strategy over the last 2 years, I think you would have seen prices lower earlier, and you would have seen the U.S. shale industry not grow as fast, and the provider of capital not being as willing to jump in, and the market probably would have been a little bit healthier. But I would say that for those who had been watching these issues closely, there were very easy ways to mitigate all those risks that we just talked about. And fortunately, I think our clients were able to do that. We're able to, make it past the worst, which I think we've seen the last couple of months.
Well, it sounds like it, because your clients are some of the only ones that are not, they haven't graduated to zombie status yet, as I like to say. So one of the things that everyone was plain out asking is, where is the demand for demand? We're seeing the world open back up slowly but surely. There's some places that did not really close at all. And yet, you know, on LinkedIn, which is our primary platform as an industry right now, we're seeing cheers when we cross $40 by like 5 cents. We are seeing, you know, people praising the 1.4 million barrel increase from like last week, that we still had arguably somewhere between a 38% to a 42% decline in demand on a global scale. Where is the demand for demand? I don't think there's such thing as a V-shaped recovery in the oil and gas sector or in the energy sector.
Yeah, which may not be, we may have entered a new phase where demand doesn't look like it did before.
Yeah.
Does it return?
Yeah, well, you know, there's all sorts of different ways of looking at this, and what we have to remember is that it's not just a domestic issue. You know, it's international too. And when you start looking at international real-time metrics of petroleum demand, it gets really tough. But here's some things that we've seen just in like announcements from China. It looks like China is importing oil at a rate that's comparable to where it was before COVID. You can see that their refineries are running very hard, especially the independent ones. They were early on to start ramping up and to try to serve the demand that had been not served there for the last couple of months.
They're fighting the petrodollar. Come on now.
Yeah. Well, and then what I'd say about the market is telling us things too. Like there are ways to see in the forward curves and see how prices are trading that will tell you if demand's coming back. And a key one is the shape of the Brent curve. So Brent, you know, light sweet crude, internationally traded. It's delivered, you know, basically on the water. So it serves as kind of a international trade benchmark. And so that forward curve has it shifted from, at the worst, it was upward sloping. So it was contango, meaning that the near-term contracts, the near-term demand for Brent crude was apparently a lot less, and it was oversupplied than if you just looked a month or two down the road and you realized that prices were quite a bit higher. Demand was apparently forecast to be coming back, and there was expected to be less supply in the market. And so that severe upward slope in the forward curve, and I can show you on a chart if that would make more sense.
Oh, yes, please.
Yeah, so I just happen to have one.
Oh, wow,
looky here.
Go.
It's not Brent, but it's WTI, and it'll show us a lot of the same kind of thing.
We
so
like our West Texas Intermediate, don't you worry.
It'll do. So what this chart shows is across time, different parts of the WTI forward curve. And, you know, WTI to Brent, you know, that the price spread or price difference between the two, it varies from time to time, but it stays fairly consistent. So we can use this as a proxy for what happened to Brent, what happened internationally. So these are different parts of the forward curve. And so you can see this, you know, this dark blue right here. I would really like to use my old pen. There you go. This dark blue right here, that's the prompt month. So that's the most nearby contract. And then the rest of them are different parts of different strips in the forward curve. So for example, the gray one is Cal 21. That's calendar year 2021. The blue is Cal 22. And right now, you can see that all those prices have really coalesced to around $40, $41. Okay? So that means that the forward curve is very flat. And no matter where you look, it's like $40 to $42.
Yeah.
Contrast that to where it was, say, early in the year when we had a crude go over 60, and you had the front month price get more expensive than the rest of the curve. So that means that there was more net demand for near-term crude that you can get your hands on really quick. There's a lot of demand for that, and it was pulling up prices. Okay. Remember the negative price day? Who doesn't?
Yeah. Everyone
right.
does.
So on that day and the days around it, you can see that near-term prices for crude were many dollars cheaper than the rest of 2020 and the back of the curve.
Yes.
All right. So what happens there is you start looking for ways to store the crude, because you look and you say, well, I could sell crude right now for $15, but if I could somehow wait for a year, I could sell it for 30. And so you had people say, and you don't do that. You don't wait a year to sell crude, but you might wait a month. And the way you do that is you go rent a tanker. You go get a dirty tanker, get it on the water, you put crude in it, and you say, I'm just going to hold it until next month. And so that's what happens whenever near-term prices are cheaper than the rest of the curve. Well, what happened in the last couple of days? You see that number right there, that dark blue number?
Is that the $40.44?
Yep. And what happened is that it got all squished. So the whole curve became about the same price. In the Brent market, in the international market, near-term prices actually went just a little bit more expensive than the next month's. which means that now that's a big sign that things are recovering because people are bidding up. They're raising that price. They're looking for oil right now, and that's also a sign that tells you that people don't want to store oil in offshore tankers either. Very good sign. So when you talk about the recovery of demand, there are some things in the market that say, yes, demand is coming back. It's industry stats, it's government stats, but the market itself is telling you that things have cleaned up. And that's a big reason why you see WTI, Brent, all these things that are raising up over $40.
So a lot of people use the filling up of SPR as their sort of indicator with what's going to happen next, but that fluctuates constantly. And there are even some that are looking, old salt domes to store crude until that next year, which, like you said, wouldn't necessarily recommend, but there is that discussion of what can we do to put it away to keep it off the market. So what are your thoughts on people utilizing that as sort of their benchmark?
Well, it's another good one. The SPR is a little different because there's only a few people who can use SPR, and I don't know how much it costs them to put that into storage, but we can't say it's a representative sample of the market because there's only a few people who get to participate. But here's what I would say. Like we had clients who were actively looking for empty tanks on leases, like during this period of time right here. Actively looking for any spare tanks they could find, old unused ones, to be able to take oil off a pipeline on a truck to their lease, put it in the tank, wait a few months, sell it back into the market. And there are hedges that you can do to take advantage of that. And that's what they were looking to do. And it was more than one client, and they were looking for anywhere they could. And that to me was a great indicator. It was showing that, hey, there's things. There are things afoot to help solve this problem. And I bet you there's 1,000 other stories just like that of people finding places to put crude to avoid overwhelming the system back then.
Well, hopefully it's a part of my inheritance strategy. We'll find out. But then what we're also seeing is that at the current prices, the majority of the energy sector, that being oil and gas, is not profitable. So how do you hedge when you are not in a profitable segment of your industry? And then we even have companies that they're, cash flow negative, but they have such a steady and consistent stream, thank you, conventionals, that they can tell you exactly where they're going to be in the next year and a half. And with so many people honestly giving up on 2020, and I advise people not to stop thinking we've still got 6 months left of it, but everybody is like wishing ahead for Q2 21. Or 2021. And what is your advice? What is your strategy if you've got a client coming in and saying, you know what, 2020, cancel culture, I'm out. Let's get into 2021. By the way, we're still cash flow negative.
Yeah, so once again, it goes back to like individual companies because, I can think of one client in particular, large volume out in the Permian Basin, and, their lifting costs are close to $11. And so for wells that have already been drilled and are already flowing, and they weren't planning on drilling any new wells in the near term.
Lucky them.
so for them, $11, you could still make money and keep the lights on. And I'd go back to this chart, and when you say not profitable, there's different ways to define profitability.
Well, yes.
It's sometimes you can get creative with it, but on this chart you could think about, well, profitability. I could draw a line right here, and I could say that if you are able to go higher in this pyramid than this, then you're creating free cash flow.
Okay.
But that doesn't mean that you're technically losing money if you are having to settle for goals that are lower than that line. Because it's possible that you do have enough money, you are creating enough cash to at least invest in your existing assets to keep them running. So like your question is, if somebody comes to us and says, hey, I can't make money at these prices, what do I do? Well, there are, the first thing I would say is, okay, let's take a look at your existing hedge book and figure out what we can do. No, and I'm serious here because what happened over the last couple of months is you put on these hedges, and then when prices go down, they're an asset. They're worth money.
Yeah.
So, for example, if I put on our average swap value, or we're struck at $59 for 2020, like before when we were going into this, like going back into March. For the rest of 2020, our average swap that our clients had on was $59. So when prices fell to fairly quickly fell to $39, that swap is worth $20 a barrel. So however much you had, you've got this theoretical pot of money that you could deploy in a lot of different ways. And that could mean that you use it for, emergency rainy day fund to be able to satisfy some of your bills that you have to pay right now. It could mean that you pay down debt. It could mean that you take some of that money and push it down the road to next year to give yourself some support there. You can move your hedges around. And that's exactly what we do, is if you do have hedges that are worth money right now, they're an asset, we figure out how to help you readjust that portfolio to make it meet your needs. Now, if somebody just comes in and says, I don't have a hedge program right now and I can't make money at these prices, that's a much more difficult situation.
When the bank is no longer confident in the market, what strategy is there to secure a hedging strategy, so to speak?
Well, I mean, on the A&D side and some of those aspects with it, I mean, I would say it's what we're seeing right now. The guys that are looking on that side are typically coming from a space where they're not, they're either new entrants, meaning like it's new capital that they're coming in with. And so that kind of changes some of this, like it kind of on the pyramid here cuts the bottom portion of this off, because there's new companies. And so it's a little bit different though, because those guys are going to be in a healthier position. But what is interesting and how it goes into the hedge programs for some of those companies that are coming with this is that, and I think that this is one of the things that goes to your point on just kind of the new operating landscape that we're in, is that structures on deals have changed quite a bit. Whether that's coming in with new A&D opportunities, a lot of these guys are looking at production buys and securitizing assets and doing distribution models. And so it's been interesting from me as a BD guy, seeing what's kind of coming in. The new opportunities that have come in this environment have been a lot of the guys that are like, like the securitization deals or distribution models are intriguing, because there's a ton of hedging that you do right out of the gate on that. And that would be kind of, that they're just starting at that top tier of the pyramid right there. Right. And so I think that it's been great for us, because we can add a lot of value in that we can help, help them efficiently, effectively, and swiftly execute on a strategy like that, help save them money in getting them best pricing, on the hedges. But I think that it says something to kind of the capital that's coming into the space and how people are taking a unique perspective on how to structure deals, more so than kind of the previous, a lot of private equity capital that was in there looking to build a position out, develop it out to a minimal degree and looking to flip that to some of the larger players. Now it's kind of turned more that there's consolidation, and so as a part of consolidation, there's consolidation of assets, right? And so in some of the mergers that we've seen, some of the larger publics, that's led to acquisition opportunities for some of these guys that maybe they're looking at. I was talking with a team that they had done a few successful runs of flipping some assets with private equity capital, and now they're putting their own capital together, and they're doing they're going out and they're acquiring some conventional assets, conventional gas assets, but they're going to do a kind of a securitization deal on it. And it's interesting, seeing the different structures that are coming up with.
What is the future of NGLs? I mean, should people start shifting in that realm? I mean, there's so much happening. We're seeing locations being built, ports being built. Everyone wants this. It's an international conversation. Like, should people start throwing their money towards NGLs?
Oh man. Okay. You're going to have to extend this podcast by an hour, because I'm getting excited. All right.
Go for it.
Yeah. So NGLs are a very complicated set of commodities. And I love talking about them because they're influenced by natural gas. They're influenced by crude oil. They're influenced by plastics. Like they all, and they compete against each other. And of course, our clients, produce oil and gas, and so the ones that produce rich gas or associated gas tend to have a lot of NGL content, and we hedge them quite a bit. What I'd say about the future of NGLs is the last couple of years, and you have to look at them individually. The last couple of years, there's been always this promise that there's more demand coming. Like
Yes.
among ethane, there's a lot of olefins plants. So these are ethylene plants. So they're often called steam crackers, and they've been designed to take in cheap ethane and make ethylene out of it, which then you can go make plastic out of. And it's like these crackers are take forever to get built. And like you see that the one's supposed to be finished by the first part of 2019. 2019 goes by, it doesn't get finished, and finally it happens in 2020. Well, it just so happens that all those crackers that had been planned and got pushed back, they tended to come online all at the same time, like right at the end of last year, beginning of this year, and that happened at so we got all this demand. At the same time, what did you have happen with associated gas whenever oil prices went down? Shut-ins.
Mm-hmm.
And it also looks
everyone's
like,
new favorite topic, shut-in.
yeah, well, when you shut in oil, you shut in the associated gas, which means you shut in the NGL supply too.
Uh-huh.
So you had all this demand coming, and then suddenly you had this supply shock, and ethane prices went nuts. They went up. We have some models that show like key levels of resistance of where ethane is rejected at processing plants throughout the country, and it's like almost the whole country went in the money to where they were trying to recover as much ethane as they could. And in the short term, those prices are still elevated, and it's a great chance to be able to take off some risk.
Yeah, that's something I know we've been busy with clients on the NGL front.
Oh, do tell.
And then
yeah, just with the opportunity to Matt's point. I mean, it just these are those types of things that again, Matt and his team watching the market and looking at the trends and seeing where there's some opportunities and then relaying that to our clients. But I know that I was looking through some of the content they put out last week and the Trader Corner, which is some of the technical, not factors, but technical aspects that our trade desk kind of coordinates in with Matt and his team, and NGLs have been a big topic and something that I know that we've been addressing pretty frequently.
That's funny you say that, because I'm not seeing that as such a prominent topic as I would think you would be discussing right now. Right. Especially like on the boards that is LinkedIn, and I know I keep going back to it, but that's where everyone seems to have found their voice these days and just won't stop talking. So why isn't that being addressed more?
I mean, I think. I'll start and then I'll let Matt finish. I think that part of that is just that stream itself. You look at it and what it means into the overall revenue for these companies, and it's just always kind of taken a back seat. And so I think that it just doesn't have the allure that the topics of especially with a volatile market in crude and the pricing that we've seen there, that's front and center. And I think that NGLs have just always kind of been, like I say, taking a back seat to that, and that's why you don't hear about it as much.
But it sounds like Matt is telling us that NGL should be like the primary child.
Oh, no. I can't go that far. I love NGLs, but I can't go that far. They're treated almost as byproducts in a lot of cases, because if you're in a rich gas play, then chances are you're getting most of your revenue from gas. If you're in an oil play, you're getting most of your revenue from oil. Both of them will make NGLs. It's just a lower part of it's a less material part of your revenue.
Correct.
But the other reason is they don't get a lot of attention is some people don't even account for them directly, and so they just account for their oil and their gas, and they skip through NGLs. But I would say, and the other thing is that they're illiquid, so they don't have as many buyers and sellers financially, and so they're more difficult to trade. But not for us. I mean, we got just about every counterparty you can imagine that trades NGLs. We have good relationships with them. So that's the other thing. And the other thing is like there aren't many people who understand them really. There's about there's probably 10 NGL analysts in the world, and you're talking to one of them right now. So.
So what's the future hold for NGLs then? Because I know I stopped you a little earlier to pick on Rob a little bit, but
yeah, the future. Okay, so the near future, ethane prices are really elevated, and there's. I don't want to go into too much detail, but they're I do want to go into detail, but I'm not going to. They're an elevated price when you compare them to other NGLs and natural gas. So it's a good time to hedge those. When you get out into 2021, ethane prices kind of collapse, and they're not as expensive as I think they should be. The future of NGLs is really, I think that the ethane market is getting very healthy, a lot of new demand. The future of the NGLs is going to be, we don't really have any more domestic capacity to consume NGLs. We don't want any more propane. We don't want any more butane, not really. But the international world does. And so I think that you're going to see expanded exports out of the U.S. Gulf Coast in particular to be able to more connect our propane and butane prices to the world. That's going to be the key. And also there are several projects on the Gulf Coast to expand export capacity in the next year or two.
Absolutely. Well, that's all very exciting. As you guys know, I am an advocate for the small operators across the country, and especially here in the Rockies. You hear about the big guys in the news all the time, and they have teams dedicated to this, right? The small guys don't. They kind of learn as they go. So hearing of these new pivots, these new avenues of opportunity, I mean, when people are coming in, are y'all helping sort of renegotiate or sort of re-strategize their path forward in those terms of these pivots? And if so, kind of give us some inside secret trader sauce. What's happening? How are the little guys going to survive this?
Yeah, with a lot of these, that it's kind of these pivot deals that they're putting it together. It's really helping them with the strategy just straight out of the gate.
Mm-hmm.
So it's not really like shifting strategy as much as, some of these guys, like I say, it's new deal structures too, right? And so they may be looking for some help on the hedging front because they just either haven't had to do it in the past. I mean, one of these, actually this team in one of their iterations, they were telling me in two of their iterations previously, they were like, we never really even got to the point that we had an ISDA in place to trade on one of the two, but we sold it out so quickly. The A&D markets were so frothy at the time. They were able to flip, a Permian deal so fast that they never even had to think about hedging. And now the hedging piece is directly tied into their acquisition strategy. And so
100%.
that's where we certainly can add a lot of that's our bread and butter, right, is
Mm-hmm.
coming in and working with these teams that, hey, I'm not the expert in this, but turn to the experts, and the guys like Matt and Karen on our trade desk, and our team. We've got the expertise, and can help kind of walk them through that. But it's definitely different for some of the smaller guys too, because a lot of them, like you say, they don't have the resources, they don't have a risk management team,
Mm-hmm.
they don't, they're not in the market each and every day and looking and seeing where the where prices are at, and then working with their counterparties to get fair pricing on it. And so there's a lot of pitfalls that can kind of happen when you don't have those resources. And we are basically a team to be plugged in that's a full risk management team.
Yeah.
And that's all that we do. That's all that we focus on. And so it is pretty fun to be able to work with some of these guys that, you can see the real value right out of the gate. But, the strategies are different for the smaller guys. And Matt, I mean, talk a little bit about that, because I know that you've been kind of front facing with some of those recently.
Well, yeah, I mean, first of all, smaller companies that I think are the most rewarding to work with.
Well, good. I like that.
Well, because you're usually dealing with sometimes a founder,
Yes.
or you're dealing directly with executive management. A lot of the larger companies, the hedging decisions, or this is relegated to a role player within the corporation. With the smaller companies, you're dealing directly with the people who have the most skin in the game. And so I think it's very real for them, and to us, it's a higher level of responsibility, because we know that the advice that we're giving is likely to be considered and might be acted upon. And so for the smaller companies, we get a chance to learn more about what their goals really are. I would say that they tend to be more open and to trust us with more, and it's really, really fun thing to do. Rob's probably heard me say this 100 times. Like, the most fun thing I get to do is the counseling sessions. It's the back and forth, the Socratic idea, like arguing back and forth with our customers, with our clients.
He always says that, and I think probably in 80% of those cases they don't believe him. That he's like, I mean, I've seen Matt likes it when they push back, because that is what does create dialogue and where we get to understand the client's needs and everything. But like I know that he hates it if we're on a call and they're just kind of quiet and they don't challenge him on anything. But you can kind of hear him laugh a little bit when he's like, "Do you want to fight? Does anybody want to fight about that? Does anybody want to challenge me?" And people are kind of do you really want that? But
bickering leads to the best resolutions, hands down. I mean, the oil field is becoming more collaborative, and if you're not willing to talk to your advisors, then why did you hire advisors?
100%.
100%.
Yes, we take that extremely seriously.
So, Rob, you said something interesting about how y'all are advising on the investment. I know you kind of went into it a little bit from the small operator side, which is definitely close to my heart. I don't want to see the death of small operators, especially in this pivot. But one thing that was coming up, and this is my curveball, I'm sorry, private equity. Have y'all seen around the social sphere that is oil and gas now, the call for the death of private equity and this emergence of a new structure, a new model? And people are saying that, I mean, anywhere from the Daily Post to the nightly news, people are saying that there's no longer a drive for investment in the energy sector. And it's kind of funny because they're including all energy alternatives and everything, but they forget that the health of the energy sector and most other industries across the globe begin and end with the oil sector itself. So are you sort of seeing it more, I guess what they're called, independent private investments back into the energy sector? I know you're probably involved. Are you seeing companies from different sectors crediting oil companies in any way to diversify their portfolios? What's happening with this new money?
Yeah. Yes on all of those. And
Okay.
I'll start this and then hand the baton off to Matt if he's got anything to add. But
Sure.
a couple things with what you said there. One, there's always going to be a space for private equity at the table in our industry. And when these blanket statements of the death of private equity in the industry as we know it, I don't
It makes for a
necessarily.
good podcast title.
Yeah, right. I mean, and that's what some of those are. But but just like everybody else, they're shifting too. And it's been interesting that we have seen a lot of that here recently, in that we've had a lot more dealings directly with private equity, with the sponsors themselves, and that I think that just through this downturn and they've always realized the necessity for hedging, but I think that a few in particular that we've seen of late have been thinking, hey, we want to set a policy across the board. We want to have the ability to quickly see what's our exposure across all of our investments. We also want to have a kind of sole source of what's our view on the market, and working with somebody that can give us a true objective kind of third party opinion and market view. And so where historically we were working more directly with the portfolio companies and the management teams there themselves, we've seen a lot more inbound interest from private equity at the sponsor level, wanting to work directly with Matt and his team and our trade desk and say, let's create that common view across the portfolio. Let's create a hedge policy. And maybe that's not something that says everybody is going to hedge 75% of PDP out 24 months or whatever. There's a range in there that they can work with, but that has been pretty interesting across our team, just seeing that and the outreach and, our beginning to work more hand in hand directly with the private equity sponsors. I will also say, I've seen a lot. There's been quite a few teams that have gone out and they're kind of trying to do the fund model themselves, where it's like a hybrid of a management team as well as the PE sponsor, right? So a good example of that is like Scout, right? That they have separate funds. They go out, they raise their funds, but they're the management team that's managing the assets themselves. And I've seen more of those kind of that people are going that route, and it seems like a lot of them have some background that maybe they were sponsored by private equity in the past, and now they're kind of just trying to go directly out there and do some of that themselves, raise the funds, and then they'll manage the assets. So it's been interesting kind of seeing some of that shift as well. And then, like I say, just some of the deal structures and how they're going about it has changed a little bit. But Matt, anything to add on that?
Yeah, I'd say that there's. I'm glad that nobody's saying that there's not private equity money out there. I'd be more concerned that people would have that opinion, but because the truth is there is, and it's just in my point of view, it seems like there's a lot more competition among them now than there was a year ago.
Yes.
So, and
even
that's a really
year
good,
ago, yeah, like you're saying, even just a year ago.
Mm-hmm.
Right. I mean, we hear that, you know, there's just no money available for natural gas investment a year ago, and I'd say that is definitely not the case now. In fact, we've seen several people who we support, or clients of ours, who look for assets and lose deals, and just because there's a lot of competition out there.
Mm-hmm.
But I think that there's a hedging component of this too that's really important, because it allows these private equity firms to make more aggressive deals. For example, like if you're looking at a property and you know that, like say it's a natural gas property, and you know that at the current curve, or let's just say, at the current curve, I could make a 20% rate of return on the asset. But I also know that if prices slip lower whenever I sign this deal, if prices were to slip lower, then my valuation is in trouble. Well, if you have a team that can immediately go out and hedge those prices for a big chunk of the economic life of that asset, then you can be more aggressive in your bid, because you know that you can lock that price in on the same day. And we've seen that happen a lot, where on oil and gas, where they're over, it's always working overnight. These bankers like working all night, working in. So they're just like, sleepy-eyed, crazy-haired, in the morning, and saying, all right, well, we're going to close today. Like, what price can I get today? And you're
That's
like,
the uniform of the oil field. Come on.
We're all in the same boat sometimes. But yeah, and then they'll have to, they're able to sharpen the pencil and say, okay, this is going to be my bid, same day. Get all the hedges off, and that way you've secured your valuation. So I hope to think that an aggressive hedge advisor is helping increase the bids out there for assets that need to be sold.
So across the board, you typically saw that rig count was an indication of health in our industry, and not necessarily the market side of our industry, just that we were growing, we were developing, we were still locating and finding. There was still some exploration to a certain extent. People were interested in their assets. We also saw, the fall of the money was the ducks. So you follow what the large majors were doing in order to know when the great big, new basin was going to reemerge. We did it when we saw the death of the Bakken. We've done it when we've seen the birth of the Delaware. It's a fairly easy cycle to happen, but last week alone, rig count was at historic lows. I think the final number was something below 275. We're seeing ducks grow more so than decrease. Usually you see the healthy fluctuation. Still, I think pretty consistent around, 8,000 or something like that across the United States. But everything seems to be standing still. So what is happening to our service side of this industry from y'all's perspective? And what are going to be the new indications of health from the operator service tech companies?
I see Matt's getting on the computer.
I know.
He's queuing it up.
He's queuing it up.
I don't have a chart on that, but I do have another way to.
The fake out, head fake there.
I do have something
He's
else.
He's checking my 266 rig count.
That is my personality, I have to admit. So here, what I'd say about the rig count is, the rig count used to be a good indicator of activity. I think in the short term, it's not as good of an indicator anymore. First of all, because you got a rig out there, you're just basically punching holes in the ground. You're not saying how many wells are going to be turned to sales. There's a really interesting one out there. Primary Vision, the company, is they do a frac spread count, which is the number of completion crews that are active in the country.
That's gone way down.
You way down. I mean, it was something like 350 by their count just about 6 months ago.
Yeah.
And the most recent number I saw was under 60. Yeah. So, that's way down. You want to talk about rigs being down, like number of completion crews, and why? It's because, 30, I think we're getting up to close to a price that would encourage some development, but, $30, $20, you're not going to go and try to complete a well at the moment. And so, and I do want to share this because I think that the services industry is a big flag to watch. So this is our factor matrix, and our style is, we don't have like a bank price deck where we're saying like we think that price is going to be $46 next year. We're risk managers, so we're always thinking about in terms of probability, risk skew. And this is for our crude oil factor matrix. And what we tried to do is identify what we think are the most prominent variables affecting oil prices right now, and the ones that are likely to affect oil prices in the near future. And we put them on a sheet. We share this with clients so that we can have a good discussion. Like I said, I pick a fight. and I always ask for things that I'm missing. So if you have anything you think I'm missing, or anybody's watching this think I'm missing something, let me know because I want to put it on.
Oh, they will.
Do it.
They will.
I'll fight you.
Get the boxing
No, I
gloves
would
on.
love to talk to them. Yeah. So the way this works is if something is down here at the bottom, wish I could work PowerPoint. If it's down here at the bottom, it's something that's priced in. All right. And if it's up here at the top, we think it's more of a surprise. The market might know about it, but they're not giving it the proper weight. And so, for example, the big green one right here, COVID-19 demand and the state of the economy, that's the big bearish demand side thing that we think is, kind of halfway priced in right now. It could get worse, could get better. But one of the things that we've been identifying is that even if you have a rally in oil prices, it breaks through those thresholds that we saw on the pyramid that we showed, and you get up into the prices that encourage more development. Growth CapEx. Okay. The things that we're concerned about is, and this is actually a bullish thing, is that this oilfield service and capital markets, if prices do go up that high, will you be able to find money fast enough, or if you're a public company, will you be rewarded for drilling new wells so that you can respond to that price? But the other question is, let's say that your prices go up and I can find the money. Will you have enough services there to be able to respond with a new well? And we got it up high. We don't have it as something that's like an imminent thing that's gonna send prices way up, but it's something to watch because these people they're furloughed. I mean, some of these are friends and family of mine. They're furloughed. Mm-hmm. They're at home. They're questioning their involvement in this industry anymore.
Oh yes.
And if you have equipment, that's just on the people side. On the equipment side, it's in warm storage. It's offline. So how do you get equipment into the field, the people into the field, properly trained? Can they respond quickly? And I think it's a big doubt. And so if you can't respond with the oilfield services in a timely fashion, then this leaves some upward price skew in oil, because you could have this lag between whenever there is the demand and when you can actually provide the supply.
So one of the things that was being asked is that a lot of people, those being the operator side, some of the people I pinged for questions are saying, well, when we start seeing a return in demand and therefore a increase in price similar to what we're seeing now, it's still $40, but people are optimistic. They're grabbing on to the little nuggets and they're staying, positive about the industry. Where they're kind of negative is that they are then hit with service side fees because service side tends to stay, and again, technology or actual physical, like drilling a well, fracking, workovers, what have you, they tend to stay more guarded for longer periods of time, and thus you get an inflated rate of engagement. And that also produces an environment where operators don't want to move forward because they think they're being cheated in some capacity. And I completely understand that. So how do you negotiate your way through the settling of supply and demand? Because to people, without looking at charts, we are so far down on our demand, our history of demand and where we fall within the degrees of error on it. And that's what's leading way towards this sort of battle or this continuing reactionary battle with service companies. And thus you get in a cycle where nothing gets done. So are people just reacting to headlines, or are we better than we think we are despite these weird dips?
Let's just remember that supply and demand affects every link in the supply chain. And anything that can change its supply and demand, and it will respond to price. And so services are one of those things. And so what I would tell people is that when prices go down low, who's on the tip of the spear? It's the oilfield services guys who are on the tip of the spear. They're the first ones to feel the pain. They're the first ones who get their contracts canceled. The first ones that get told no. So what you can expect is that, when you have to bring it back, when you have to renew that demand for oilfield services, and that goes for completion crews to whatever it would be, you would expect that you're starting from a level of lower supply and prices could escalate right there. Now, from our point of view, what we're trying to figure out is the effect on price. And I think anytime that you add a cost in the supply chain, you tend to raise the overall price. And that's why we identify it as a bullish factor.
So in the long run, it's actually doing us a favor, even though we might hate it when we're signing the MSA.
I'd say if you have access to the services, if you're one of those who does not have trouble finding what you need, then you're in a position to be able to better take advantage of higher prices if they happen.
Yeah.
Fabulous. I will tell my boss that because he was none too pleased the other week. So we are looking at, a new landscape completely in the oil and gas sector. Some argue we've never seen anything like this before, but what most people do agree on is in some way it's OPEC's fault. So I'm kind of curious from y'all's perspective. Over the years, we claim that OPEC is no longer a thing. They're inactive. They can't keep it together. And then something like this happens, and all of a sudden, OPEC was more powerful than we gave them credit for. So can we rely on OPEC? Should our industry, being, the privatized oil and gas out there, should we be negotiating ourselves to a point that OPEC's reaction is our future? Or what can we be doing in order to better, protect ourselves, separate ourselves, or honestly, be better players in the global economy that is oil and gas? Because you're not going to get away from global conventional production. And right now, America does not control the global tap. So how do we play with OPEC successfully and for long term?
Well, I know you're going to be shocked that I'm going to say this, but you hedge. That's how you do it. You don't let them like OPEC dictate what sort of price you're going to receive, and you do that by systematically adding hedges across time to make sure that you're protected in case they do something crazy. I mean, like the problem we had with OPEC this year was really just a matter of time because they had been holding back production. They had been holding it back quite a bit. And demand was growing really fast, and that was supporting the market too. And I'll show you a chart here. I know you're shocked that I've got a chart ready to go. But I'll show you a chart. Like, first of all, on our factor matrix again, I mean, what did we have on here? We got OPEC on here twice.
Yeah.
I mean, that's how much attention it needs.
I see you have OPEC Plus, so you've joined this new trend of OPEC
That's right.
Plus.
You're real high on that name, aren't you, Catherine?
I cannot stand that name.
I can't say GLOPEC. The global OPEC. I can't say GLOPEC. So we got it on here twice, and we got it as a bullish, mostly priced in for their new round of production cuts, right? I mean, they got 10 million barrels a day offline or something like that. I'll show you a chart in a second. But the other thing we got is, so that's bullish priced in. So it can hardly make the market any better because not only is Russia, Saudi Arabia, other OPEC back in on the deal, but they also stuck it to Nigeria and Iraq and told them they have to make up for their past cheating. I hate to call it cheating, but they didn't meet the quota. So that's like, how could that not be priced in? Yeah, from the outside looking at it. Yeah.
That's fair.
Yeah, okay. Well, I don't know. But on the other side, though, is like, okay, so that's all priced in. Well, what could happen in the future? And that is you've got a bunch of supply that they could bring online. So, for example, like here's total OPEC production like per month, and the red line is how Brent ended the month. But you can see back in 2018, you remember when we were supposed to put all these sanctions against Iran, like in late 2018?
Yes.
And everybody thought that production was about to come off in a huge way. And then at the the final hour, the 11th hour, it was they kicked the Trump administration, kicked those sanctions down 6 months down the road. Well, what did Saudi Arabia do? They decided they were going to produce, and they bumped up total OPEC production to about 33 million barrels a day. Big mistake, because what happened to the price?
They didn't get the memo.
Yeah. Well, so if you ever think that OPEC has superior, market analysis, no. I'd say we have access to information that they would love to have. But you saw that prices came right down because they miscalculated. But here's what I want to point out is like recently the target for their production is around 24 million barrels a day.
Correct.
If they have produced 33 in the recent past, and let's just knock Iran off that and say that they don't count this time, then there's if you did include Iran. If you did include Iran, then maybe they could produce like 10 million barrels a day in the near term. But let's just be more conservative and say it's 7 million barrels a day that they could bring back online over the course of a few months. That I would argue that in the total demand for the whole globe before COVID-19 was about 100 million barrels a day, and production was about 100 million barrels a day. So they've got 7% there just waiting in the wings. What I would argue is that if you have a bullish point of view for crude oil in 2021, it is required that you assume that OPEC will keep their deal together. That's the way I would say that.
Okay.
Because if you add 7 million barrels a day to this supply-demand balance in 2021, you don't get $40. So the other thing about what OPEC has done recently is, over the last 2 years, like 2017, 2018, and really 2019, I guess, let's give it 3 years, is if you listen to their rhetoric, they talked about how oil prices, that first of all, they lamented the fact that U.S. shale was in the mix, and they said that we need to systematically reduce the global supply to draw down global inventories, so that if you don't have too much oil inventory, then the price will reflect what's going on with supply and demand.
Mm-hmm.
They have totally changed the rhetoric on that. The rhetoric now seems to be it's a month-to-month deal. You can't count on us to continue doing this past the next several months. You have no idea what we're going to do in 2021. You have Russia that came kicking and screaming to this new deal.
Yep.
You have barely get compliance with the rest of OPEC. And you have Saudi Arabia and Russia in the last several months showing that they are willing to let a deal fall apart. So what do we have now? We have a deal through July, I think. Maybe it's a little longer. I'm not sure.
Mm-hmm.
But I would say that when we go back to that price chart, remember when we were looking at prices, hovering around $40 to $42 for the next couple of years, I think the market's getting it right. They're looking out there and saying, there's this huge risk that OPEC could end this deal again. And we would have that supply right back online. So let me ask you a question. I just became the host. I'm sorry about that. Let me just ask you this. If Brent pricing, or let's just say WTI, if WTI got to $50,
Mm-hmm.
do you think OPEC would keep this deal?
So that's like the $1 million question, right? Because it didn't become it wasn't necessarily a price war in the beginning, I think it was, but then it became who's bigger chief on campus? Who's going to let the other one fail first? And Saudi was not willing to lose to Russia. Russia's been stockpiling. I think people could back it to 5 or 6 years ago, they really started this initiative. And then, you see Mexico, so that plus part of OPEC plus, trying to jump in on market share. And that's what it all goes back to, is when you see one fail, the other jumps in for market share. Again, going back to the control of global conventional production. The real wild card is shale. And that is why, West Texas has become kind of the thorn in their side, because we never ramp down. And that goes back to my argument of sometimes we tend to shoot ourselves in the foot because we are privatized, and we do want that market share, that pipeline out there. So if it goes back up to 50, do you think they're going to keep their deal? I think it depends on who challenges them and what the end goal is, because the end goal really isn't always about sales. Sometimes it's about, global control in terms of who has the bigger seat at the table.
I think that's fair. I'd say, and I want to add on to your U.S. Shale argument too, is that if I think that OPEC knows very well some of the things that AEGIS knows, where I'd say we have a very good representative sample of producers in this country, the size of the book, the variety of different producers that we counsel, and I think that if you look back at our trade history, whenever WTI went to $52, that seemed like a major threshold of our clients who wanted to add hedges, who wanted to lock in prices. That's kind of where it started. At around 56, 57, you saw a huge amount of interest in new hedges. And that to us, and we also get to see, whenever people change their production forecast for the next couple of years. And around that level is when these producers were adding new hedges to be able to grow. And I think OPEC knows that at some level too, that if you let WTI prices get over 50, you're going to encourage growth.
Correct.
And so back to your point, like, are you willing to give up market share? I think there's got to be a contingent inside of OPEC that realizes that and doesn't want prices to go over 50. In fact, I think the number's probably lower than that.
So to y'all's point, even if they are hedged, can the U.S. market, that being our U.S. conventionals, our shale, our gas assets, can they survive under a continuous $50, $50 cap set by OPEC?
I'm glad that you said that, not me. But I'll just go ahead and use it. The thing about like uncertainty is that it tends to introduce volatility into prices, and if you're prepared for it, you can make volatility your friend. So if you know that, say, you're on some sort of financial threshold where, under 50 you don't really hit the rate of return that you would like to have. Over 50 you feel like you're doing a lot better.
Mm-hmm.
I would say that you can, if you have a plan together where you know what those price thresholds are and you have a hedge advisor who is on your side waiting to execute, then you develop those plans in advance. You have the people, the processes, and the technology in place. That's your hedge advisor like us, and to be able to execute. And then whenever you get the opportunity, you execute quickly.
Mm-hmm.
So even if $50 is, say, like some sort of cap that OPEC thinks should be out there, that doesn't mean that the prices are going to stay at that level. You'll get opportunities to hedge when prices are temporarily strong, and that's what I would advise people to look for.
So on that advice, this is quite a whammy to the shale environment. You're seeing the geos and the reservoir engineers and some of management start pushing back and saying, we need to relearn the conventional game. We need to learn about development, not just like a single well and hope we do well in that regards. So you don't see this downturn as the death of the shale market, as it sounds. I'm tend to be somewhere in between pessimist and optimist, but how is the shale game going to change as a result of everything that we've seen with or without hedging?
Yeah. Well, one is, and I know you've heard this word before in this argument before, not the word, but the argument, and that is, consolidation. I think that there will be. We've seen it among our clients.
How's that going?
So we are in the fortunate position where our clients were well hedged, and so a lot of the decisions that they've made over the last couple of months haven't been, many times were not emergency measures. They were able to psychologically distance themselves from what's going on in the market and just make a wise decision about what the new market is going to look like.
Which is fair.
And I'm glad about that. But as far as how things are going to change, number one is that I think that hedging is going to be more important than it was in the past, because if there is some sort of theoretical, who knows where it is, cap on price, because OPEC could at any time dump these barrels back into the market, then you need to be prepared for that, and you need to know where your thresholds are. The other thing I would say is that hedging becomes important because the margins might be thinner.
Mm-hmm.
Mm-hmm. If you
I think we're already seeing that part, yeah.
Yeah, and so that's when having the processes, the technology, being able to know exactly where you are in your financials, exactly where your hedge portfolio is, how much room you have to add hedges, how much do you need to have, what is your bank telling you have to do versus how much of it is discretion, and knowing what limit orders that is, what prices do you need to have ready to go in case you hit those prices. That's going to become very important. And I would say that we have the technology to do that. So that's the way we've built the company, is to have the tech to be able to pull that off. But it's gonna. I don't think that, even though I do think that say 21, 22, 22 prices, I don't think that $41, $42 is fair. I don't think that's the right price for what's happening in the market right now. I do think it'll tend to go a little bit higher, but I just also recognize that there's just the sword hanging over our heads, which is OPEC, that we just need to really be aware of. And there's also the demand side issues that haven't quite solved themselves yet.
Rob, what do you think in terms of business development and what you're seeing coming out of West Texas right now?
Out of West Texas, or just in
shale.
general?
Yeah. It's everywhere.
Yeah, right. It's still, there's still a lot of undeveloped positions that are sitting out there that are kind of on pause right now. But I think that you're going to see, especially if we get into a period where there's it's not as volatile, I guess, that there's some stability, and I think you're kind of seeing some of it now, that as we've gotten, and who would think that, like, people are optimistic in the high 30s and low 40s, but I mean, I can say from a standpoint of, I've had a lot of inbound calls coming to me here recently from folks that are more ready to start thinking about hedging again, or ready to start thinking about it now. And I think that's just that goes to show that there's still going to be capex that goes into these plays, and there's inventory that's sitting there. I think the landscape is going to look different. I think that there's still a wave of consolidation that still needs to happen, and a lot of that is going to be with the big shale players, and we've seen some of it, but my personal thought is that there's definitely more to come. And I think that it's interesting. Like I say, I think that I've been intrigued by seeing the inbound calls coming from some of the shale players that they're ready to start thinking about mitigating risk and looking at mitigating risk on their forecasted production. And again, as absurd as it sounds, in a price environment that looks optimistic in the high 30s to low 40s, so it's the game has changed, right? I mean, it's just those kind of thresholds, I guess, have changed for some of these folks, but I think the landscape is going to look a lot different a year from now, just in the number of players and how much consolidation there's been in some of these big shale plays. And I mean, we're seeing it in some of the names here in our hometown, Catherine, here in Denver, and there's been some consolidation, and there's going to be more of that to come.
So y'all have taken us through so much today, and it's been so helpful. I greatly appreciate it. Looking at the market, like you said, if we see negative again, and there's always that looming threat that we will, especially in this day and age, you're telling people not to panic so long as they're properly set up. So looking at the oil market, the energy market, and what everyone's asking is, when do we get above 45? When is that actually going to happen? What are y'all's top indicators that you encourage your clients to look at to understand not just the health of the oil field, but the health of the oil market, so that we bring everything together and see that future growth happening?
Matt's got a crystal ball that's just this great tool that
it's a series of crystal balls. It's complicated. It's mathematical.
Yeah.
Yeah, I can tell you there's a difference between the short term and the long term health. I mean, short term, there's a lot of government statistics and things that you can find in the market that will tell you how things are doing in the short term. And I don't mean like charting tools. I'll tell you about those. Longer term is really like most of what we do is counseling clients on how to hedge going out 2 to 3 years. So we tend to think shorter term about opportunities in the market in that way.
So you're done with 2022.
Yeah, we're
as well. You're done with 2020 as well.
Yeah, I want to see 2024. I'm done with this. Things will be so much better in 2024. Some of the things that I look at, I think one of the very important things right now is the level of inventories, and not just like how much is in inventory, it's where and are we building or drawing. And I can give you an example is like in the US, WTI futures are delivered to Cushing, Oklahoma. Like whenever you trade a WTI futures, that is required delivery and taking delivery in Cushing, Oklahoma at certain facilities. But that's not the only price marker in the U.S. I mean, there's some very liquid ones in Midland, Houston, Southern Louisiana. There's a few in the Rockies, and they're important too. And what I'd point out is that one of the things that we look at a lot is the whether inventories are rising or falling in each one of those markets. So in Cushing, inventories are falling fast. Okay, because people are trying not to send oil to Cushing because it got into such a bad way back in April. Where things are increasing now is on the Gulf Coast.
Yes.
So like Texas, Louisiana, Mississippi, that stretch. That is still
Mississippi's coming back.
Catherine's hood.
You lived in the or you're from the SPR's backyard too. So you got like inventory builds in commercial storage in the Gulf Coast and in SPR. And if SPR wasn't there, you'd actually see bigger inventory builds in the Gulf Coast. So that's the new one that I really want to watch to see if the supply-demand balance is flipping to where we need to take oil out of storage. That's going to be a huge milestone. The other one that I watch on a weekly basis is refinery runs. So we can talk about like gasoline, diesel, all that. You can see gasoline demand's coming back, diesel's demand's coming back. But when you get down to it, there's only two ways that you can dispose of crude oil in this country. You can either put it in a refinery or put it on a ship. That's all you can do. If you don't have that demand, you got to put it in storage. And so we need to watch very closely how refineries are responding to margins in their world.
So Matt, Rob, thank you so much for taking the time to speak with us today. As I said in the beginning, this has opened the doorway to a lot of people voicing their opinions, but what the oil field needs now is honest, transparent, and actionable rhetoric. And I think that's what you guys were able to provide today. I know I learned a lot. I very much appreciate the insights. Anytime you have some insider trading to like throw my way, please feel free. But otherwise,
we don't do that.
They're both saying no automatically. That's so disappointing. But one of the things I also want to point out, Rob, you set me up with the AEGIS notification I get twice daily about the market. And that is one of the things I look at constantly and helps me just kind of keep abreast of what what's happening really across the oil patch in general, because we tend to stop thinking outside of our own assets. And so I would encourage anyone to figure out a way to get on that mailing list because it's pretty gosh darn helpful. But otherwise, Matt, thank you so much for bestowing the knowledge today. Rob, thanks for the BD insight. And I can't wait to get you guys on in the future, especially when we crack $45.
Looking forward to it. It's our pleasure, Catherine.
Yeah.
Thank you so much for inviting us.
Really appreciate it. Yeah.